Next up, we do have Tony Cousins from Perfect International. So just to check that Tony is online with us.
I'm here. Yep.
Hi, Tony. How are you?
I'm great. How are you?
Not too bad. Glad to see you surviving the 40-degree temperatures in the UK.
Yeah, it was only for 2 days, and the country ground to a halt, which is very embarrassing. But we're through it now.
I spent 8 years in London, and I remember the famous quote was, "Summer's my favorite day of the year." But it sounds like that day has now gone to a couple of weeks, which
we'll get 2 days. Yeah.
Of course, my colleague Doug Nicol is quite close to Tony on the strategy, and Doug gave me a little intro to say here before we passed over to you is, well, your bio that Tony is CIO and CEO of Perfect International. Tony's presentation talks to Perfect's proven ability to stick to their processes, which has delivered success for their clients over the past 28 years. And Tony, I don't know if you've been there for the entirety of those 28 years, but I think if I rewind 28 years ago, I was fielding fine leg for my under 12B cricket team. So have you been there since the beginning?
I've been there for 33 years. So,
well, I must take this up with Doug. He's 5 years short. He's undersold you slightly.
Okay. Well, I'd like to say I joined at the age of 12, but that wouldn't be true.
Okay, ageism aside, I'll pass over to you now, and you know the drill. You've spent a few of these workshops with us, and we'll catch up with you in about 15 minutes or so.
Okay, great. Well, thank you very much. Thank you, everybody online, for your time today. I know this is a short and sweet format, so I'll get straight to it. I'm here to talk about the second quarter for the Cautious Fund, which Perfect runs for the Ned Group program. And it was a pretty brutal quarter. We saw sharply negative moves in really all asset classes, obviously other than cash. Equities were down in the US and non-US in double digits from the index point of view. Similarly, double-digit declines in non-US dollar bonds. US dollar bonds didn't obviously have the currency effect, so they were down, but not down as much as other asset classes. So pretty tough environment in which to make money, and I'm afraid to say we didn't make money, but we did manage to protect investors in this fund in a number of ways. The first was the low allocation to equities. Some of you may know we reduced equity allocations some time ago because we were concerned about valuations, and obviously a much higher allocation to equities, and we can go to 40% in this product, would have led to a lot more downside. So having a low allocation helped, and the types of equities we had also helped. Both within non-US dollar equities and US dollar equities, we materially outperformed the general market by concentrating on value and quality stocks. Within bonds, similarly, the most damage was done at longer duration levels, longer maturity bonds. We have a very short duration in this portfolio, and that did protect the fund. So we outperformed in US bonds by a little under 4%, and in non-US dollar bonds by a little over 6%. In terms of currency, the Australian hedge we had on added value, obviously, as the Australian dollar fell. So let's look at those currency movements, which really were the main culprit for delivery of a negative return over the quarter. The dollar was extremely strong. It continued its trend of appreciation against all currencies. We have managed to insulate the fund to some extent against this. The yen, which was the weakest currency, the yen exposure in this portfolio is very small. It's only about 1%. Similarly, the euro exposure is only a little over 1% as well, so that protected the fund. And as I mentioned, the Aussie dollar, which was the second worst performing currency was fully hedged back to the US dollar. So again, we insulated the fund against the decline in the Aussie. However, we do have exposure to sterling, to the Canadian dollar, and to the Swiss franc, all of which showed some depreciation, not as much as Aussie and Japan against the US dollar. US dollar is a very expensive currency now, but I think this is a function of concerns about the economic situation in places like Japan and in the Eurozone as well. So cheap currency, expensive currencies can always get more expensive. They will eventually correct, but it's just not happening yet. Let's just talk a little bit about the backdrop to the quarter. Any of you who are over in London would have seen this slide from me at the summit. This really just talks to, I think, the transition that the global economy is going through. Before 2008, nobody printed money. It was just seen as an outrageous thing to do. Along came the financial crisis, and this tool was legitimized. It wasn't just left to the likes of Zimbabwe and Argentina. Developed market central banks started doing this, but they, with hindsight, did it with some degree of restraint, and we saw about $10 trillion printed over 12 years. The problem has come because another $12 trillion was then printed over 2 years when COVID struck the world. And this was a gargantuan influx of liquidity into the system, and it wasn't withdrawn in time. They didn't take away the punch bowl from the party, and the excesses that have followed are a real concern. They take the form on this slide of inflation. Inflation is going up everywhere, probably with the exception of Japan, and the central banks have proven to be asleep at the wheel, and they need to bring this under control. The concern is just how much damage they will do to the world economy in their actions to bring it under control. Looking at the effects of this liquidity on markets, it did drive equity markets to really quite excessive valuations. This is Warren Buffett's favorite valuation tool for the US market. This is now 3 standard deviations outside its long-term average. For those of you who study statistics, that means that variables only spend 0.3% of their time outside of the 3 standard deviation range. They spend 99.7% of the time within 3 standard deviations. So this is eye-wateringly off trend and expensive. And despite the fall in the US market and other markets, it hasn't been corrected yet. It was led by the technology sector, the FANGs, as they became known. And we can see on this slide, these sorts of bubbles have been seen before, and they all deflate. I think the problem here was the degree of this bubble was actually greater in terms of outperformance than previous bubbles like the Nifty 50 or the dot-com boom. And just to sort of a note of caution, whilst a lot of these stocks have fallen and fallen sharply, this has only retraced about half of the outperformance that it showed. So we think that this still has further to go, and it is concerning. What we did to protect your portfolio is reduce the equity weighting. We have been up at 30% at the beginning of COVID. When COVID struck, value returned to markets, and we did take the weighting up to 30% then. We have subsequently, in 2 steps, brought it down and kept it down until better value returns. And we don't think that that has happened yet. What we do here is we work with trigger points, which are preset based on earnings and dividends data, and we hard code these into the Bloomberg machine for market levels at which we would consider what we call a value indicator to have improved sufficiently to increase the equity weighting. This is still some way off for this product, which has significantly more exposure to the to US equities, because the US equity market remains a valuation outlier. So we are keeping our powder dry, and rule number one at Perford is don't lose the money. Turning to bonds, we see bond yields based on current inflation have fallen to somewhere between -6 and -10% in real terms. And what the bond market is telling central banks here is you need to get inflation under control, or we are going to do it for you. So unless there is signs that central banks are able to tame the beast, they've let the genie out of the bottle, they need to get it back in, and if they don't, the bond market will do it for them. So that is why we are seeing really quite hawkish commentary coming out of the Fed and the ECB, the Bank of England, the Bank of Canada, the Bank of Australia, really all the major central banks with the exception of the Bank of Japan, because this is their job. They were asleep at the wheel. They believed inflation would be transitory and could just bumble along between 1% and 3%, and everything would be fine no matter how much money they printed. And they were wrong. And now they are trying to play catch up. And I think we can expect some very sharp tightening from the central banks. And the concern is that they will break something. Let's remember that the majority of cyclical expansions since World War II have not died a natural death. They have been killed by central banks tightening to reduce inflationary pressures, and that is what we would expect this time as well. And just one other additional note of caution, I think this is very concerning for Europe in particular. They have added disadvantages compared to the US in firstly their exposure to Russian energy, and they are waiting with bated breath to see whether the Nord Stream pipeline is turned back on. But even if it is, it's quite conceivable that Vladimir Putin will just cut gas supplies in the middle of winter, and any recession will be very deep if that happens, because Europe has got itself, this is a problem of Europe's own making, into a terrible spot with its reliance on Russian gas for its energy needs. And they are now really at the whim of Vladimir Putin, and he's obviously shown he's not someone to be trusted. So in summary, this is the portfolio for the cautious fund. It is very, very defensive, only 20% in equities, big portions in bonds, but the modified duration top right hand or bottom right hand box here is very low, actually 0.9 years. These are not bonds that can make you a lot of money, but they cannot lose it for you either when yields go up. If you own long duration bonds, 30-year bonds in this environment, if yields were to just rise 1 percentage point, you would lose 20% of your money. So duration is really investor's enemy in a rising yield environment. When it comes to equities, firstly from a country exposure, you can see we very much favor Asia excluding Japan. These markets are significantly cheaper, and in terms of economic health, they are in much better shape. They have better demographics, greater labor force growth, and better productivity growth. They have less debt penetration, higher savings rates. So those are all indicators of long-term health of an economy, and markets like Singapore, Australia, Hong Kong, Taiwan, Malaysia, and in Indonesia, I think will continue to show growth, and that will be to the benefit of the companies that operate in those jurisdictions. Elsewhere, in the Eurozone, the exposure within this portfolio is entirely in Scandinavia and Central Europe, Germany, Holland in particular, and we also have a reasonable weighting in Switzerland. We have no exposure at all to peripheral Southern Europe. The news is coming through this morning that Mario Draghi, the Italian Prime Minister, has finally managed to resign. This is his fourth attempt, and Italy is in a lot of trouble. It was in trouble before COVID came along, and it's in even more trouble now because its debt levels have gone up, and what it is paying for that debt is rising sharply, both in absolute terms and the spread over German bonds as well. So, with the issues I've talked about in Europe, I think we could be looking at another Eurozone crisis developing later in the year, and we are keeping you away from that. In terms of the types of stocks we buy, that's shown in the bottom right hand box in terms of yield, debt to equity, and profitability. This is a combination of quality and value. This is what a perfect portfolio always looks like. It's always high yield, it's always higher ROE, and very importantly, in a rising interest rate environment, it is also low debt to equity, much lower debt to equity. A lot of companies took the opportunity of ample liquidity and very low or sometimes even negative interest rates to load debt onto their balance sheets, and they may well now be regretting this particularly if they haven't fixed it for a long period of time. Some companies were smart enough to do that. Many others were not, and they are going to be seeing sharp increases in their interest bills. That is not going to happen in this portfolio because we have shied away from indebted companies. So, in summary, I would love to be bringing you better news than this, but I think there's a lot of problems out there. The economies and markets of the world are going through an adjustment after many, many years, more than a decade, of exceptionally low interest rates, exceptionally easy monetary policy. The world has changed. We now have inflation, and this is something that needs to be tamed, and the medicine is pretty harsh. And so I'd advise everybody to stick to high quality, liquid investments, and stick to your process, stay in the cave, preserve your capital, but then have the discipline of process to put that capital back to work when better valuations surface. They always do. They will this time. You just got to be patient and not let the money burn a hole in your pocket. And that is what we are doing for this product. So thank you very much for your time today. Very happy to take any questions if anyone has any, but that's what I wanted to say today.
Fantastic. Thank you very much, Tony, and good to know there's a steady pair of hands at the wheel there at Perfect. I also really appreciate your analogy about removing the punch bowl from the party. In fact, you had the production guys chuckling away over here. It sounds a bit like 10 Downing Street during COVID lockdown.
Yes.
I also appreciate your slide looking at equity valuations and how you played that out through COVID. Looked like you upped your allocation a little bit as some of those names started to add a bit of value, and then kind of tapered down your equity position. So you spoke a little bit about looking at some of the stock numbers as they come through. I mean, there's been a lot of rhetoric currently around potentially a disappointing earnings season globally, but particularly in the US and Europe. I mean, do you envision this? And at what point do you say, or look at certain numbers and say, okay, now's a nice entry point for us to up some of that equity allocation in some way like the US? Or are there still too many moving parts to make any assumptions at present?
Well, I think we do envisage earnings declines. One of the problems is margins. Margins are very, very high, which is testament to strong management at companies that they've managed to get them up to these levels. But one thing the 70s showed is when inflation is taking off in its early stages, companies cannot pass through price increases quickly enough to match the increases in their costs, and their margins get squeezed, and that will happen this time. We've already seen it in companies like Walmart and Target, for example, and there will be more of that to come. And earnings estimates really haven't come down yet, and I think are way too optimistic. So that will happen. But you know, the long-term trend of equity markets is up, and they generate 5% real, 5 to 6% real in the long run. And when they get back to a valuation which is consistent with that, we will buy them. We know that within the opportunity set for this portfolio, equities in the long term will be the best performing asset class. You just don't need to own equities when they're very expensive, as they still are. Cheaper than they were, but they still are. So, you know, this is about patience. It's about not committing the money until you're being remunerated for the risk. But when that does happen, you've got to take the emotion out of the decision, because things will look bad. But when the numbers look good, we will be going in and buying equities, and that's what we have always done.
Okay, excellent. Thank you very much, Tony. Unfortunately, that is we all have time for today, and thanks for letting us know that Mario Draghi managed to step down. It's a strange one when a PM kind of steps out of power. Usually they're trying to hang on to it, so maybe it says something about his character or the fact that he's a bit disenchanted with Italian politics. And that Euro crisis that you mentioned potentially happening down the line is always kind of a worrying factor. If I reflect back to the previous crisis a few years ago or a decade ago, whenever it was, and you always get that nuance within Europe of, you know, your Western Europe and your Germany, Southern Europe, and then Eastern Europe playing out, and it's all these countries under a single monetary policy obviously makes it quite a tricky playing field to navigate. So thanks for the work that you and the team are doing, and we appreciate your time today, and we'll catch up with you in 3 months' time.
Okay, well, thank you very much for your time. Always happy to be here.
Cheers. Take care.